Welcome back. Nigeria Mortgage Refinance Company plans to seek approval from members by the end of the month to triple the size of its debt program to 440 billion naira. That's about $1.44 billion. Nigeria set up a mortgage-backed guarantee company in 2014, partly with World Bank aid, in an effort to boost lending through the creation of a secondary housing market, which is virtually non-existent in Africa's most populous nation. NMRC says the notes could be issued through non-convertible loans and bonds, either through public offering, private placement, or a book building process. And Ecobank has mandated international lenders to arrange investor meetings in Britain and the United States, after which it plans to issue a 5-year dollar-denominated bond. Ecobank, which has operations in 36 African countries, has hired Deutsche Bank, Standard Bank, and Standard Chartered to arrange the meetings. Proceeds from the offering will be used for debt refinancing, among other things. And economic experts have called for increasing general trade between African countries to connect opportunities within regional markets. At the Trans-Regional Conference of Standard Bank in Lagos, the experts provided insight into how best to leverage Africa's full cross-border potentials for about 50% of trade flows in the continent.
It's very important to give the regulators the business view, to share best practice across the globe. I believe, for instance, if one looks back retrospectively, part of the challenge with the Kenyan interest rate cap and floors, really stemmed from, the fact that legislators felt that the banks didn't care, were hiking up interest rates and really were only thinking about themselves. So it's important that there is proactive engagement about issues that are relevant to the economy, and together we can craft a solution to address a real concern. The other example I will give is in the agricultural space in Nigeria, where the central bank, together with the banks, policymakers, state governments, came together to put in place a risk-sharing framework, to address lending to the agri sector, and that helped to increase the credit that went to that sector. So I think it is critical. Every year as well, Standard Bank operates a regulatory college with central banks on the continent, and we also participate in supervisory colleges that the South African Reserve Bank holds, for its colleague central banks on the continent. So I think continuous dialogue is critical, for us to craft the right regulations that will move the economies forward.
The truth is, though, that there are too few of these stories, and that the population of African multinationals is too small. Earlier today I was at breakfast talking to some of our clients who are here today, and they were recounting the very real challenges they face in trying to operate across multiple countries. And so while we may put in place the Africa Continental Free Trade Agreement, the reality on the ground, what happens at the borders, what happens at the ports, makes it very, very difficult for people to expand their business across multiple countries. So I think it's really imperative for all of us here, and clearly the group of clients that we have here are interested in growing across multiple markets, to work both at a financial level and at Standard Bank. We want to be helpful, but also to continue pushing at a policy level to ensure that the challenges of operating across multiple African countries are reduced so that we can see many more African multinationals arise.
There's always a concern, of course, when you've got an oil and gas sector that is developing, or any mining or any natural resource sector that is developing, that it could lead to what is called a Dutch disease, in the sense that all the resources of the country basically become consumed with the development of that sector without there being much attention paid to other sectors of the economy. So the governments will have to be cognizant of the potential for those sectors to divert attention. I mean, one of the benefits that we have in East Africa is that the economy is very diversified. Mm-hmm. If you look at exports, the export bases are very diversified. There are some countries on the continent that have dominance by one export sector. Oil, for example, in Nigeria accounts for close to 90% of total exports. There is no sector in Kenya that, and in Uganda, that accounts for more than a quarter of total exports. That's how diversified the economy is. That's how diversified the export base is. So making sure that those benefits of having a diverse economy, a diverse export sector, do not get thrown away because of the development of the sector. It's something that the government will have to actively make sure it doesn't happen. So government involvement and government policies will play a pivotal role in the development of those sectors in those economies. So my own personal view is that given the fact that those economies have developed to the extent that they have developed up to this point, the likelihood of the oil and gas sector leading to a Dutch disease is very, very, very low at this point.
And South Africa will find it harder to raise funds and service its foreign debt after a worsening of external financing conditions in recent months due to a fall in the rand and rising bond yields. And that's according to rating agency Moody's. Moody's says Moody's was the last of the top 3 major rating agencies to rate South Africa's investment grade. In March, it affirmed that rating and reversed its outlook to stable from negative, citing an improving policy framework. However, in a research note published today to flag potentially tougher times ahead, South Africa's public debt has risen to more than 50% of gross domestic product over the past decade as fiscal and policy missteps under former President Jacob Zuma, including firing 2 respected finance ministers, which saw the country downgraded to junk by 2 of the top 3 rating firms. Still in South Africa, Bank Capitec has dismissed a Bloomberg report about a probe into Capitec's loan orientation charges, saying the article was misleading and fake. Citing an unnamed source, Bloomberg reported that the South African Reserve Bank had asked the National Credit Regulator to launch an investigation into loan orientation fees charged by Capitec. In a report released in January, Visory said Capitec boosted its income by charging excessive fees on its multi-loan product, which carried a monthly charge by allowing a previously vetted customers to extend their facility by answering some questions. While Capitec says it terminated the product in 2016 after rules introduced by the NCR meant it was no longer viable, Visory said that the lender rebranded it and that Capitec's methods risk over-indebting consumers. And that's it on the program. Thank you very much for watching. I'm Chimeze Obi Iwawo.